If you own a company and you're running your business through there and your accountant has said that you shouldn't pull out director's loans or what they call Div 7A, then listen to this, because there's probably a strategy that you could be using that would actually increase your wealth and your overall growth plan. What I'm talking about is using surplus funds or cash within your trading entity or your trading company to fund other investments or other operations without having to pay more tax than you should. A lot of accountants will basically give you this recommendation that Div 7A is bad, don't do it. If you do it, you're going to be taxed more. And yes, that's true if unused correctly, but if you use it strategically, it's basically an unsecured loan that you are obtaining yourself, which has only been partly taxed, meaning that you could utilize the untaxed portion for investments. So you're using money that's not necessarily yours personally to then grow wealth outside of your business. It's similar to the way that Robert Kiyosaki talks about, utilizing loans, external loans. So money that's not actually yours to further grow your personal wealth or your business wealth. And so that's what I want to talk about today, because this one tax rule could completely change the outcome and the speed and trajectory of building your wealth itself. So this is not something that's for everyone. This is more for those that discipline and aren't wanting to use the surplus funds for personal items, trips overseas and funding lifestyle items. It's more for those that are wanting to potentially find opportunities or implement or use the money to be able to get into opportunities like developments or property or other businesses or even building their own personal brand. Now, as a disclaimer, this is not financial advice. This is tax strategy on how it can be utilized. And this is also just what we have seen and how we have worked with clients before on how they could potentially utilize the director's loans to build their business and anything outside their business as well. So let's jump into it. What's most important, first and foremost, is that a lot of businesses that are run in companies, they pull out their money to themselves or to a trust, and where they will get stuck are 2 points. One is that they don't have the proper documentation or the compliance around pulling out that money so that they don't get stung with what they call an unfranked dividend. And the second is that they use that money for things that aren't potentially going to grow and that doesn't allow them to repay back that loan. Remember, this is a loan that is owed back to the company, and it can be paid back in several ways. You can pay it back with cash, you can pay it back with non-cash dividends. There are several ways to do this, but you need to strategize this with your accountant. How can you potentially use this in a hypothetical world to actually increase your wealth? So an interesting way of doing it is making sure that if you had surplus funds, again, I'm always talking about surplus funds that you do not need to run your business, and the opportunity cost of leaving it in the business is actually worse off than actually investing it somewhere else. Let's just say you had the opportunity to purchase a property, and this property here wasn't your principal place of residence. Let's just say it's a property that you wanted to purchase. You had the opportunity to do it. It's off market, able to then purchase it, let's say within a trust, and for whatever reason you need some additional capital or cash flow to either pay for the deposit or to renovate to allow you to have a higher income stream in terms of rent or selling it down the track. A lot of business owners, what they will do is they'll pay themselves an increased wage or a dividend in their company, and in turn allows them to borrow more. It also extracts a bit of money out of the business, but what's actually happening is as you grow your wealth and pay yourself more, your tax becomes much higher because you're now putting yourself into a higher tax bracket. For example, if you were to extract $1 million out of your business, you're paying a significant amount of tax compared to leaving it in the company, the tax being only paid at 25%, and then loaning that money to a trust, for example, as a Div 7A loan, and then using that money to actually fund the project, fund the purchase. And time again, we've seen our clients execute this in a well-structured way that, if planned correctly, they know that they have to pay that loan back within 7 years. Yes, there's interest on that, which is deductible. Yes, they have to make restructured payments, but it's just like any other loan that you would get from the bank. The bonus and the benefit is that this is your own money that you're using, essentially. You haven't paid full tax on it. And within a 7-year period, you're hoping to extract a capital gain or some type of cash flow profit from there, which you can, one, pay back to the company, and two, you've been able to execute an opportunity that you didn't have before. And so if you use this in conjunction with proper tax minimization, so setting yourself a wage or dividend at appropriate amounts, you're using this in conjunction with being able to lend with the bank, and you're using this in conjunction with extracting additional surplus cash flow, you could create yourself opportunities that you never had before. Discipline and diligence around this is essential. Compliance is essential. However, if your accountant is telling you not to take out a Div 7A, I want you to question them, and I want you to ask, oh, what is the opportunity cost of actually taking out? What is the tax consequence? What are the interest consequences? And then have a look at the gain that's potentially there if you were to take it out. Always offers opportunity cost, risk, implementation. Is it worthwhile? And if that's the case, then execute. So if you have any issues and you have any concerns, or whether you're looking at these sort of strategies, feel free to contact us.